This is Bill Hornbarger, Chief Investment Officer with Benjamin F. Edwards, with a few comments on the interest rate cut from the Federal Open Market Committee today. Well, the Fed decided to move aggressively and cut rates 50 basis points in a move that was well telegraphed to the market, at least in terms of direction, if not degree. In the comments surrounding the interest rate cuts, the Fed talked about economic uncertainty, but they also mentioned very specifically that they feel that they've made significant progress in terms of inflation moving more sustainably towards the 2% goal. I think that the message in the larger cut is that the Fed has some lingering concerns about the softening that we've seen in recent months in the inflation data. This is the first move in over a year from the Fed, and it's the first interest rate cut in more than 4 years. We have to go back to COVID, March of 2020, to find the previous interest rate cuts. Overall, we think this is bullish for the markets. There's a lot of things that work in the markets, but we think this will be bullish for equities if we look intermediate and longer term. The economy's still on solid footing. The GDP now forecast from the Atlanta Fed is for a 3% GDP in Q3 of 2024. Inflation is coming down. If we look at the Fed's favorite measure of inflation, core personal consumption expenditures, the last 3 months on an annualized basis show it actually well below the 2% target rate. And although non-farm payrolls have been moderating, we're still averaging over 200,000 in terms of new jobs every month, calendar year 2024. In addition to that, we're near or at all-time highs in the stock market, and typically rate cuts near or at all-time highs are followed by a pretty good return 12 months later. So generally, again, we think this will be positive for the markets. We would be remiss to mention, if we didn't mention that this is an election year. Typically, we do see a little bit more volatility in the months coming up to the election. September, historically, the worst month of the year for stocks. Election year, September and October tend to be more volatile, tend to be a little bit weaker. But again, we'll get through the election. We'll have that behind us in 6 or 8 weeks. And we think with the Fed now on the path to cutting rates, soft landing scenarios still in play up to and including today, we think that the financial markets will likely benefit from this as we look out intermediate to longer term, 6 to 12 months.